mind, looking for a dime. James Locke in the house, gonna help you shine.
All right, welcome everyone. Welcome to the Poole Locke YouTube channel. I'm James Locke. We're going to answer 2 more Ask James questions of the day. We have this question from Nicole. She says, I always hear what you say. I'm an engineer. I'm a female engineer. I know that's a little unusual, but I'm thinking about managing my own money in retirement, which is also sometimes considered unusual. I think I would do the best job. My plan is to stick with mutual funds, and I don't think that will require much work overall. What do you think? All right, Nicole, I love it. Thank you for coming here. There's women out there watching. That's awesome. That's super awesome. I love it. And like I said, there are female do-it-yourself people everywhere. In fact, I just had one the other day in my office, and I think women have the propensity to make better do-it-yourself investors than men. Because men, you get ego, you get control, you get certain factors that can cloud judgment. But the only problem I have, and if you're an engineer, you're probably mathematical enough. If you took some time studying before you got to retirement in those transition years about the various income generating tools, you could probably be fine. And if you like doing it, that's fine too. The only problem I have with that, with what you said though, Nicole, is you mentioned mutual funds. And mutual funds, I believe strongly, are not a good tool for most people in retirement. And here's why. Let's split up stock funds and bond funds, right? So first of all, bond funds, when people buy individual bonds, they buy them because they want a fixed interest payment for the life of the bond. And they want a fixed repayment of the face amount, the principal at maturity. And that's why retirees love bonds. The problem is when you buy a bond fund, neither of those two guarantees exist. Both guarantees are off the table. Why? Because there's no fixed interest payment. It can fluctuate and will fluctuate on a regular basis. Number 2, there's no maturity date, right? Because mutual funds don't mature. So there's no maturity date, which is guaranteed to pay back the full face amount. So when you're buying a bond fund, Nicole, you're literally buying the stock of a company that owns bonds. That's the definition of a bond fund, stock of a company that owns bonds. It's a risk, it's riskier because you're losing those 2 guarantees. What if you went to higher dividend common stocks? Okay, but good luck finding a higher dividend common stock mutual fund that's good. In fact, Nicole, I will tell you, we were so frustrated trying to find an exchange-traded fund similar to a mutual fund that had a high dividend, that kind of high dividend common stock, but sought a good, sensible stock strategy, that we got so frustrated not being able to find one that we created our own exchange-traded fund at Sound Income Strategies, right? So it's really hard on the stock side because most stock managers are afraid that, hey, if I deviate too much from the S&P 500, which is at an income yield of 1.3% right now, if I deviate too much, there's going to be years where I underperform and I'm going to lose my job, right? So as a result, they tend to be closet indexers. They tend to follow the index. Now let's talk about some alternatives for income-focused investing in retirement. Instead of relying solely on mutual funds, you might want to consider a mix of individual dividend-paying stocks, individual bonds, perhaps some carefully selected ETFs that focus on income generation. Now, as an engineer, you're likely to have the analytical skills to research and select quality individual stocks and bonds. For stocks, look for companies with a history of consistent dividend payments and growth. These are often found in sectors like utilities, consumer staples, and some healthcare companies. Now for bonds, consider creating a ladder of individual bonds with different maturity dates. This can provide a steady stream of income while managing interest rate risk. You might also want to explore other income assets like REITs, real estate investment trusts, or master limited partnerships perhaps, right? These can offer higher yields but come with their own set of risks and tax implications. And you need to fully understand that. Remember, the key to successful income investing in retirement is not just about generating high yield, but also about preserving capital and managing risk. You'll need to balance your need for current income with the need for some growth to combat inflation over a potentially long retirement. So that's the problem with mutual funds. Whether you want stock funds or bond funds, most likely it's going to be really difficult getting funds that specialize in an income-first, growth-second approach. As a do-it-yourself investor, you might need to look beyond traditional mutual funds and create a more customized portfolio that meets your income needs in retirement. That was a great question. If you would like to send in your question, have me answer it on a future show, you can email it to me at poollocke@poollocke.com. So let's get to that second question. And this is from Alan. I really want to work with an income specialist to help manage my money when I retire in about a year from now. I've been to a few workshops and seminars for retirement advisors in your area, but how do I know that I'm working with a true income specialist? All right, Alan. Alan from New Jersey. Perfect. So I'm glad to hear that you're open to that. That's great news. How do you know you're going to these workshops, and if you're with a true income specialist? First of all, you may not know from the workshop. You may have to take them up on that individual meeting and use it as an opportunity to interview them as to what they're doing, what their specialty is and isn't. Now, at the workshop, you can see, first of all, what they recommend. If they recommend products, if they talk a lot about the stock market and stock picking, they're probably a growth first, income second person. So if they're not an income first, growth second, that probably doesn't work. If they talk a lot about annuities at a workshop, then they're probably just focusing on a subsector. And a lot of people who do these workshops do that. You're focusing on a subsector, which is an annuity, as opposed to focusing on the universe of income generating options. Because Alan, there's about 10 different income generating options. Annuities are really just one. Because again, so I'd be careful. To me, you need to look for somebody who is an income first, growth second person. So they can have some growth in your portfolio as an inflation hedge. That's important, right? Even as you get older, you want some growth, but income first. And specializing in the universe of income generating options is critical. So if you take them up on the offer for that complimentary meeting, and the offer is always there, there's several things I think you should do. First, talk to them about their typical client. And if you confirm their typical client is your age or slightly older, then go ahead and don't be afraid to ask, okay, what allocation between stocks and bonds does that typical client have? How many of those clients typically own annuities? What percentage? You might ask, are you using individual securities or mutual funds? So just like the previous question, right? And you heard that mutual funds are not a great tool in retirement. But if somebody says, hey, we're fiduciaries, we work with all these different income specialists, and annuities are part of it, but not all of it. Some of our clients have a reasonable portion of annuities, others have none. And then they say they do individual securities. Now you're at least starting off properly. But then you have to go and find out, like, okay, where do they get their research from? How do they do their work? Additionally, when interviewing potential income specialists, consider about asking their approach to creating a sustainable withdrawal strategy. A true income specialist should be able to explain how they can balance your need for current income with the need to preserve capital for the long term. They should discuss concepts like the 4% rule, dynamic withdrawal strategies, or bucketing approaches. Ask them about their philosophy on dividend-paying stocks. A good income specialist should be able to discuss the pros and cons of high-yield stocks versus dividend growth stocks, and how they might fit into your overall income strategy. They should also be able to explain how they manage the risks associated with, reaching for yield, so to speak. So inquire about their approach to fixed income. Given the current low interest rate environment, how do they generate meaningful income from bonds without taking on excessive risk? All right, do they use individual bonds, bond funds, or a combination? How do they manage interest rate risk, right? Don't forget to ask about their, experience with other income generating investments, like real estate investment trusts, REITs, master limited partnerships, MLPs, or preferred stocks. A well-rounded income specialist should be familiar with these options and be able to explain their potential benefits and risks. Lastly, ask about their process for monitoring and adjusting income strategies over time. As your needs change and market conditions evolve, how do they ensure your income strategy remains appropriate? Remember, a true income specialist should be able to clearly articulate a comprehensive, personalized approach to generating retirement income that goes beyond just pushing products or following a one-size-fits-all strategy. It's crucial to find someone who aligns with your goals and understands the nuances of income-focused investing in retirement. Great questions today. If you would like to send in your questions, you can do so by emailing them to poollocke@poollocke.com. And if you like what you heard, go ahead, like and subscribe to our channel. I am James Locke, your retirement income source.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Save